Welcome back. This is a Firefighter's Financial Toolbox. My name is Brad. It's been a couple days since I've made a video. I wanted to check in with everybody. I know that the S&P and the Dow just keeps going down. It's getting pretty frustrating, but I wanted to talk about if you should change how you invest. But first of all, let's take a look at what's been going on. This is the 1 month, and if you see now the high actually for the S&P, I use the S&P 500 because it's a generic, easy to look at. The Dow looks at 30 companies. S&P looks at the 500 biggest companies in the country. So it's a little bit better indicator for me as far as that goes. Now, if we go back to February 19th, which we're a little bit month past now, today's the 23rd of March, it was 3386. That was the all-time high of the S&P 500. Currently today, we're at 2234. Which, as you can see over the month, has gone down and down and down. But if we do look at that, folks, it's actually down over 33%. If we take a look at the 6 months, it really tells you how we were going along, and how quickly we've dropped off. Now, we're down a lot. So the question is, should we change how we invest? You guys know the last month with the coronavirus scares, and I realize that's a very important thing as well. But I wanted to say, you guys, don't change how you invest. You guys, my favorite way to invest is simple is better, and I've made this pretty much the cornerstone of my investing. Now, I do a little bit investing in individual dividend stocks, but that's been within the last couple of years. For 95% of my portfolio, I use the 3-fund portfolio. I call it lazy investing. You guys, you need three different funds. You need a total stock market of U.S. stocks. You need some sort of total international stock fund, and some sort of generalized total bond market fund. Now, I know bonds aren't popular right now because they're not yielding anything, and actually they're losing a little. But remember, bonds are your stability. So let's take a look at 3-fund portfolio, the lazy investing strategy that crushes the pros. All right, you guys, let's take a look. Hard work pays off. In most areas, it's true, except when it comes to investing. In fact, the upside world of investing, all evidence points towards the opposite. What is a 3-fund portfolio? Brace yourself for the boring definition of the year. A 3 portfolio is an investment portfolio which consists of, you guessed it, 3 funds. A U.S. stock fund, a U.S. bond fund, and some international stocks in some sort of fund. But why does the 3-fund portfolio work? Well, it turns out those guys that get paid to pick stocks don't do as well as they think they do as a room. So if you buy general index funds, you buy all the stocks in the index, you get whatever the stock market's giving. Now, right now, it's going down no matter what you have. So this is not a good time to compare as far as how it's going. What are the advantages? A, you get diversification. Because you use either general index funds or generalized ETFs, you get broad diversification. With a good 3-fund portfolio, you're going to have over 10 to 11,000 stocks. They're generally low cost because index funds cost less than managed funds. It also makes rebalancing easy. So when you have a big decline like we do, you can take some of that bond that is a little bit higher than you want it to, and you can buy those stocks back down while they're on sale. It's so easy to keep track of, you guys. Now, for most people, they may have 2 different retirement funds. They may have a 401k at work, for example, and maybe they have a Roth IRA. That's a majority of what people in the United States have. So you could have, let's say, an S&P 500 index fund that's the cheapest in your 401k. And then in your Roth, you might have some sort of bond fund in your 401k. If you could do those two, you could buy a international fund in your Roth, or depending on what you have, you can set this up easily. Let's look at the percentage of actively managed funds that underperform just a general S&P 500 index. So when you look at large cap, 90% does. Small cap's even higher than that, almost 95%. And as you can see, for the most part, they outperform them in all time frames. Now, there may be a few years where a fund manager does well and outperforms the index, and that happens, but they don't do it consistently for long periods of time. And remember, we're investing long term, so we want to be concerned with what's going to happen to us over all the years of our investment history. So how do you choose a 3-fund portfolio to allocate? Well, usually you have more stocks the younger you are. The closer you get to retirement, the more conservative you tend to be, because you can't take those big declines we're having right now. Now, currently, I was about 70-30 before this hit. So even though I'm down big, I have been actually selling and buying some more stocks on sale because I had the funds in my bond funds that I was able to rebalance myself back to the percentage that I wanted. So here's an example. Here's an example of an 80-20. So you have 20% in bonds, you have 64% in U.S. stocks, and you have 16% in international. A lot of people use the simple 100 minus your age rule, or even the 110 minus your age rule, which is about where I am. So you take 110 minus my age of 50, that puts me 60% in stocks. So I'm actually a little bit more than that, but I also am going to have a pension in retirement where most people will not. So every individual has to consider this. Let's talk about the 90-10 rule though. Warren Buffett, who we all know is pretty much the best investor out there, has a rule that everybody should have at least 10% in bonds, no matter how old they are. Because when stocks go down, you guys, whatever your percentage of stocks are, you can cut it in half. So you could go from 90% stocks all the way down to 45 in a extreme case, right? And remember, the U.S. represents only about 35% of the total world market. So how much do you want to pick in international? Now, this is a personal question. A lot of people choose to only carry United States stocks. I feel like somewhere around 20 to 30% is right. Vanguard's suggestion, 20 to 40% of your holdings in stock should be international. Again, that's individual choice. All of these things are individual choices, you guys. So here's an example of a 25-year-old. They're 95.5. So that's really, really aggressive, right? 75% in U.S. stocks, 20% in internationals, only just 5% in bonds. And here's somebody that's 50-50. They have 20% U.S. stocks, 25% U.S. stocks, 25% international, 50% bonds. Now, that's pretty high percentage in bonds. That might be where you are when you're in retirement and you can't risk a big loss like we're experiencing right now. So we're going to take a second. We're going to look at some different ones with the 3 large discount brokerages. I recommend everybody either has an account with Vanguard, Fidelity, or Charles Schwab because the costs are so much lower than the other guys. So for an example, if you wanted to build that portfolio with Vanguard, you could use VT-SAX, which is the Vanguard Total Stock Market Index, or VTI, which is the ETF version, right? You could use VTIAX, which is the Vanguard Total International, or VXUS for their Total International ETF. You could use VBTLX, which is the Vanguard Total Bond Market Index fund, or you could use BND, which is the same version in ETF. You have everything you need for a complete portfolio with those 3 funds or those 3 ETFs. But what about if we're going to Fidelity? Now, Fidelity does not have a large selection of their own ETFs. I will say that. They do offer free ETFs through other companies, but as far as they are, you can use their zero funds. FZROX, Fidelity Total Zero Market Index, zero fees. They also have a Zero International Index Fund, FZILX. Put that together with the Fidelity US Bond Index, FSITX. You've got 3 funds, you've got your portfolio done. Or let's say you have, your 401k and you have a S&P 500 index. You could use that fund and then supplement the rest with one of these companies. If you wanted to do it all at Charles Schwab, who is really leading the way in discount brokerages lately with their no fees, fractional shares coming on, all these kinds of things. You could get their Schwab Total Stock Market Index, SWTSX. Pair that with the SWISX, which is the Schwab International Index, and SWAGX, which is their U.S. Aggregate Bond Index, and you've got everything you need. They also have ETF equivalents. I do not remember the tickers off the top of my head for those, but I'm sure if you peruse their website, you'll be able to find those simply. In other words, using what you have available to you in your 401k as a low-cost fund. Generally, most 401ks now do have low-cost index funds, you guys. And that's a great starting point. You could have, as I said, S&P 500 index in your 401k that you use, and supplement the rest in a Roth IRA or a traditional IRA. Keeping the money costs down really makes this work. Even though we have difficult times going right now, and I'm no different. My portfolio is down about 22% overall. So it's huge in the amount of money that I've lost as well. We're all in this together. We got to keep investing. We got to keep our heads up. We're going to get through it. Do not sell your stocks when they're down. Please don't sell your stocks when they're down. All right, guys, I hope you got something out of this. If you did, give me a thumbs up. If you're new to the channel and you're not already subscribed, you guys, do me a favor and hit the subscribe button, ring the bell. You'll get notified when I make videos. I try to make 2 a week. With this COVID-19 going, I may be a little bit behind. I've been very busy at work, but that's the nature of my profession. So anyway, you guys have a great day. Take care of yourselves and stay safe.